10 million square feet of shopping centers. That's across 11 different states. You're going to hear how my guest today, Andy Weiner, the founder of Rockstep Capital, has been able to accomplish this over his amazing career. He is a proud Houstonian, a fellow graduate from Stanford University with his undergrad and his MBA at the University of Texas, and one of the sharpest dudes that I know when it comes to large-scale shopping center developments. And we dive in today on his journey, how he has been able to accomplish this amazing feat. And all of this stuff that they have going on right now is just extremely interesting. Anytime I get to talk to somebody that, one, has had a tenured career over multiple economic cycles and never had any capital calls or assets returned to lenders, you want to ask a lot of questions, shut up and listen, which is what I did today in this episode. We talked about his journey and how he started out working for his family's retail business, which led him in to shopping center investments, the different types of shopping centers and malls that they're investing in now, what his overall outlook is going forward on retail and why this is a really insulated, very bullish asset class, according to him, when it comes to commercial real estate investing, and how they are focused on revitalizing hometown America through strategic real estate investments. I really enjoyed particularly when he talked about his rock steps, which are some of the cultural values of his organization. And I think you'll learn very quickly, one, how smart Andy is, but also how much he cares about bringing value to his people, to his investors, and the communities that they invest in. And the dude is wise. So I'm excited for you guys to get to enjoy this episode with my friend, Andy Weiner. Let's go ahead and dive in. Welcome into the show, Andy Weiner. How are we doing today?
Doing great, Matt. Very excited to be here.
Yes. Anytime I get to talk retail, commercial real estate with anyone, let alone an expert like yourself, I get really fired up and excited. And we got a lot of real estate investors, a lot of commercial developers, LPs, high net worth individuals that are just always intrigued by the different asset classes and benefits and risks and opportunities that come with each one. And knowing your, experience in the industry and the space and, how much you guys have accomplished over the course of your tenure as a real estate developer and, acquirer of commercial real estate. I'm excited for us to dive in. Before we talk about, Rockstep Capital, Rockstep, and what you guys have done over the course of your career and what you're doing right now, where did your entrepreneurial journey start? I know you were here in Northern California in Stanford, and there's always some cool inception story that pulls somebody into this entrepreneurial path, specifically a niche one like, commercial real estate and the development side. So where did yours begin?
Sure. So it started with my grandfather, Matt. So my grandfather started a chain of clothing stores in Houston, our last name, Weiner Stores. We had 159 stores. So it was a regional chain. And these were clothing stores about the size of a TJ Maxx, about 20,000 square feet. Half of the stores were in the big metros. Half of them were in secondary, tertiary markets. I call them county seat towns. And so I grew up in retail. I ran the operations for the company. So I ran all the stores, store operations, finance, real estate. That's where I got to know about leasing and thinking about real estate and shopping centers, logistics, HR. So I grew up as a retailer. I've studied retail. I'm a student of retail. And then I started investing in shopping centers 28 years ago and started out doing a number of Walmart supercenter anchored shopping centers. And then I fell in love with secondary and tertiary markets. I like them because they're easy to identify risk. People want you to be successful. Mm-hmm. You can buy assets and cash flow at a cheaper price.
Yep.
And I liked the risk quotient, the risk analysis of secondary and tertiary markets. So I started this business 28 years ago. Today, we're in 11 states. We built or acquired close to 10 million square feet. We operate as an investment manager for three types of shopping centers, neighborhood centers, open air centers called power centers. And those are generally neighborhood centers, typically under 150,000 feet.
Yep.
Power center, open air centers are generally up to 500,000 square feet. Junior anchors like TJ Maxx and Ross, surrounded by restaurants and small tenants, usually in a line or maybe an L shape. And then we also play in the enclosed mall space, which is very exciting because there is $50 billion of insolvent debt underlying assets that are extremely well located and can be bought at 15 cap, mid-teens cap rates. And so they're very, very high cash flow generation. And it's a very tricky asset class, but we just love the opportunity and the returns associated with that kind of investment. So we play in a little bit in grocery anchored. We play definitely in the neighborhood power center and also in the enclosed mall space. The exciting thing about retail today is that the dynamics are very favorable. It wasn't that case 4, 5, 6 years ago, but today it is. What are the dynamics that are favorable? Number one, Amazon combined with COVID just decimated the weak players, kind of wiped them out.
Yeah.
Okay? And those that are left have their own survival strategy to compete with Amazon and actually not only protect market share, but to grow market share. Okay. They have their own set of bricks and mortar stores. They have their own e-commerce distribution strategy. They have great apps to combine their stores with e-commerce distribution. And they have figured it out. And they are growing. They've got strong balance sheets and they want to open up by 50 or 100 or 150 stores a year into an inventory that is not growing. Different than multifamily, different than industrial, where there's tens of millions of square feet added every year throughout the country. In retail, there's just about none.
Yeah. Why do you think that is?
What's that?
Why do you think that is?
Well, it's construction costs have gone up by 30 to 40%.
Economics are making the deals harder.
Interest rates. And the sales have not gone up by 40%. Let's say with higher interest rates and with higher construction costs, the cost of building is about 40% higher.
Yep.
And so just to break even on your financial analysis, tenants need to pay 40% more in rent.
Yeah.
And most of them don't want to. Okay. So if you own second generation space at 60, 70, 80% of replacement costs, and you have all of these retailers who have survived and are growing against Amazon wanting to grow, and they've got to tell Wall Street that they're growing, you've got very good dynamics.
Right.
Your vacancy goes up. You actually want tenants to leave because you can replace them with better paying tenants.
Mm-hmm.
Okay, that's number one. So the dynamics of the sector are very favorable. Second, you have positive leverage versus negative leverage. And Matt, I'll assume that some people don't understand positive versus negative leverage, but the definition of positive leverage is that the yield, the cap rate, the yield on an acquisition is greater than your debt interest rate. So we're buying a grocery anchored center right now in Louisiana, brand new center. It was demolished during hurricane, completely rebuilt. We're buying it at an 8.384 cap. We're borrowing at 6.5. Okay.
Some good arbitrage there.
Yeah. And then in the enclosed mall space, you're buying at 15, 16, 17 yield cap rate, and you're borrowing at 7.5, maybe 8%. And so that's positive leverage. By adding debt, you create value for your investors. Negative leverage occurs where your multifamily deal in LA is valued at a 5 cap or 5.5 cap, but you're borrowing at 6 or 6.5. And what happens there is the leverage hurts the returns for your investors unless you can show dramatic increases in net operating income so that eventually it becomes positive.
Right.
So that becomes a strategy of prayer. And prayer is not a great strategy in real estate.
Definitely
Okay.
not.
So retail combines positive leverage with dynamics of supply demand that are very favorable. And if you buy second generation space well under replacement cost, you're sitting in a very favorable position with cash flow day one.
Yeah.
Day one. Cash on cash returns, the enclosed mall space are above 20%. In the open air space, they're generally 10 to 14%. So you can pay current preferred prefs to your investors day one. And that allows that 30 to 50% of the return on an investment, let's say it's a 5-year investment, can be just from cash flow.
Right.
You're not betting that you're buying it at X and selling it at 150% of X in 5 years, and all of your return is based upon the exit.
Right.
Okay.
Yeah.
So it's a different level of risk and dynamics.
Yeah. I mean, when you look at what happened with so many, syndicators, multifamily investors specifically over the course of, the post-COVID era, and to your point of positive negative leverage, right?
Yeah.
With a lot of the adjustable debt that is, pro forma at a 3.5, 4.5%, and rents continuing to increase, and occupancies remaining where they were at versus what happened with the headwinds when the Fed started raising rates and rents plateauing. We saw a lot of the opposite, right, in the retail space, or at least more insulation and arbitrage to be had in many of those spaces. To your point, to share a little bit about one of my deals that I just did. I got a second gen building that was inherited, 80,000 square foot shopping center, tertiary market, that was inherited by two sisters. They didn't know how to operate real estate. It was at about 50% occupancy. I got it at $12 a square foot, and I
$12
am
a square foot to the building.
purchase
The
price.
cost.
Purchase
Okay.
price. Yep.
Works.
Yep. And it had two out parcels. Was able to liquidate one of the out parcels and, put my basis at about 60% of where I purchased the asset in the first place. Now I've got TJ Maxx and Harbor Freight
Love it.
coming
Love
into
it.
the plaza. So you got me excited talking about that,
No,
because
this is it.
those are the opportunities, right? I mean, there were a lot of people that did not want to touch a tertiary market,
Yeah.
or, a lot of equity that does not want to go into, some of those types of markets. Talk a little bit about your mindset around why you like, and maybe define it for those that don't know, like
Sure.
what is a tertiary market? What is a secondary market versus some of
Yeah.
these core plus markets that a lot of people think of when they think of investing in, nice big shopping centers?
I'm going to divide it. I'm going to use a term called hometowns, okay, which is what we use to define the markets that we like.
Okay.
Okay. And again, there's some definition of secondary and tertiary, but hometowns we put at from 100,000 market size up to 1 million. Okay, that's kind of what we call hometowns. And what we look for in a hometown is strength of demography, population.
Yep.
So you have to have, and you have to have some essential drivers that drive population. We've identified 5. Got to have major university, or major tourism,
Yep.
major government, whether it's military or research facilities, major hospital network, and major, I'm going to use the term Fortune 1000 companies.
Okay.
So if you have one, but preferably multiple of those, you are in a situation where you're able to keep population growth growing, hopefully not going down.
Mm-hmm.
And if you have growing population growth, that is very, very important. Second, I'm going to use the term small town America. It's really not, it's called hometown America.
Okay.
Hometown America is a unique place. It's a place where there is community, there are usually good schools, There's leadership in these communities that are very active. They care about the community. They make a difference. People who are very involved. Crime is generally low. Lots of civic engagement. Okay. And so one of the things I mentioned to you earlier, Matt, is we play in this crazy world of enclosed malls, okay, where there's so much insolvent debt, but you can buy amazingly good real estate at 15 cap, almost at land value. So you have a cash flow for just a great asset and a great location. We do something different than anybody in the country. When we buy an enclosed mall, we own 14 right now.
Okay.
Every time we require that we get local business leaders to be part of our equity as our due diligence. We got to check the roof. We got to check the leases. We got to run all the numbers.
Right.
But we need local business leaders who care about their community to be a part of our equity. They don't have to be a big part, but they need to be alongside my equity and our investor equity. And we do this around the country. And the advantage, well, we also get local lenders. Same issue. You have a local lender who's got a heart for that community, combined with local investors who care about the community. You are aligned with the community and with the leadership of the community, both city leadership and business leadership. And it helps reduce risk and therefore improve returns across the board. How? Dealing with property taxes, dealing with entitlements, dealing with incentives, relationships to the police department, to the mayor, to city staff. And our local investors are almost deputized leasing agents for alternative uses. They're on the board of the community college, the hospital district, the economic development district. They are attuned better than anybody about all the movement and opportunities and challenges going on in the market.
Mm-hmm.
And so as a guide to the issues and opportunities we face as general partner for that asset, it helps across the board. And we have gotten major incentives throughout the country on our properties as a result of having local investors. We have never had an issue with rezoning. And in terms of property taxes, oftentimes it's political. Andy, send it. I'll take care of it, Andy. And that's how it's done.
Yeah.
Okay.
Relationships.
And it's also more fun. You make a property better. You feel good about it, and you win because it's all community based. And it also becomes a good investment.
Yeah. I love that.
It's all about reducing risk and doing something that's right for the community as well. It's a win-win. And so that's how we look at hometowns. Now, and it's also there's a spirit, Matt, about, I'm calling it hometown markets, that's different than a Los Angeles or a Houston or Atlanta or Chicago, or even towns, cities that are smaller than those. There is a spirit. There is a community. There's something that sets it apart. It's a special place.
Yeah.
And we've decided that is a great place to invest and a great place for us to work and spend our time. It's critical. You know this. You spent time in what we call hometown markets.
Yep.
There is a difference.
Oh, yeah.
And not only can you get the community behind you, you can reduce risk, because in retail, you can identify your competition. It's not like in Dallas, you might have a shopping center, and within 3 miles, there might be 3 million square feet of competing centers. So if TJ Maxx wants to come into that market, you're not really sure how to deal and negotiate and underwrite that kind of risk.
Yeah.
In a hometown, you got to look around. There it is.
Yeah.
Okay. And they're not really building anything new. So you can understand your risk better. So you can buy TJ Maxx credit in a hometown at an 8.5, 9 cap. In Dallas, that TJ Maxx credit is 6.5, 7.5.
Yep.
Okay. And in Dallas, they're paying higher rent versus in a hometown. Let's say they're paying 15, 17, $18 a foot. In a hometown, they're paying $8 a foot, $9 a foot in rent, which means that the probability of them not renewing their option and jumping across the street is dramatically lower.
Yeah.
Okay.
How are
And
you?
what's that?
I was going to say, how are you guys finding leads and opportunities and local investors? What's your approach when you are identifying new opportunities, exploring new markets, or a lot of these second, third,
Those.
bite at the apples in the same market once you
No,
get comfortable and build the relationships?
there's in the enclosed mall space, we've identified everyone in the country we're interested in.
Mm-hmm.
Okay. So when they can be bought either off market or through a controlled process, we will figure out what is the right price using base case underwriting that we can hit a 16 to an 18 IRR. Okay. And when I use base case, I want to define it. In other words, when you underwrite, you want to assume that nothing good's going to happen.
Right.
Nothing good.
No blue sky.
You're not going to be able to save on property taxes. You're not going to be able to replace pennies at $2 a foot per year gross with TJ Maxx at $15 a foot. You can't do all that. You can't put multifamily in the corner of the mall parking. You can't do any of that. You know you'll be able to do some of it, but you don't underwrite that. The base case has to work at a 15, 16, 17, 18 IRR. And then you develop a list of what we call opportunities. We use the term here at Rockstep called ups. You have 4, 5, 6 ups. And then once you close, the base case is fine. And then you go to bat. You really try to work and get your ups delivered. And then you can exceed your base case IRR. So that's our strategy.
Love that.
Now, in terms of the enclosed mall space, what's so cool about it is very few players. So when we're bidding on a property, we're bidding against 3 players. When you're buying an open air center with TJ Maxx in LA or other places, you're bidding against 50. And the danger is that you overpay.
Right.
We are believers of being extremely strict on our acquisition criteria. We have lost 5 deals in a row, coming in second, because we would not stretch to get the deal just to get the deal done. One of them was a Reading deal that I mentioned to you. So we know on a base case, the most we can pay to hit a 16 IRR, base case, and we will not pay over it. Okay, too bad. We spent a lot of time. We lost. That's okay. You cannot overpay.
Yeah.
Now, how do you develop a network in a market you've never been before?
Right.
How do you develop a list of potential investors? That's a networking issue. Economic development, presidents of all the local banks, Chamber of Commerce. These are conversations you have that is part of your due diligence.
Right.
Okay. If the leadership, business leadership, doesn't believe in Andy, if the leadership doesn't believe in Rockstep, if the leadership doesn't believe in that asset, and if the leadership doesn't believe in that community, you have to have all 4. We walk.
Yep.
Even if it's a good deal.
Right.
Even if it's a good deal. So we want to protect our downside by aligning ourselves with business leaders who advise us. And it's very powerful. It helps, again, with incentives. It helps with rumors. We had a situation where we had one of our investors' daughter went to the movies, and there were some youths who just were saying bad stuff. You never hear that otherwise. You want to hear the bad news. Local investors will tell you the bad news and what's really going on. We changed our policy in one of our properties about dealing with teens. The next day, 4 of our investors emailed me. We had a call with them, with our operational team, and we decided not to change our policy, but we had it out with them to say, hey, I want to share with you what's happening. They didn't know, and they understood, but it's great to get that kind of challenge.
Yeah.
I'm just talking about operationally, the grittiness associated with an asset. You basically have a set of leaders who will help you. Another market, signage is very important. Okay, very, very important for retailers. In one of our markets, getting signage is an act of God. It wasn't allowed. Zero, none. So we put a whole sign package together, $500,000 sign package, really well looking, clean, crisp. Sent it to the city manager and his staff. Copied our investors locally, who were the business leaders in the market, and that's how it's done. That's how it's done.
Right.
Okay. And again, could I have gotten that approved? No, couldn't have done it. Even though we know how to run a business, we know,
Right. Yeah.
Couldn't do it. Could I have hired a lawyer out of the big city to go there and plead? It wouldn't have been effective. Okay. So, and at the end of the day, when we exit, we allow local investors, if they meet the market price when we exit, we allow them to put their own partnership together so that it can stay local in the next round. If they want us to lease it for them and do prep, fine. If not, they'll do it themselves. So stabilize an asset, strengthen an asset, and then leave it in good hands if locals want to do it. If not, there's other people around the country who'd like to own that asset, we hope. So that's the strategy.
The evolution of Rockstep a little bit more,
Sure.
and for investors that would love to get to 10 million square feet in real estate assets owned, and all the experience and the management and the company that you've built. What did that evolution look like? I mean, it's been a gradual process, I'm sure, and I'm sure you've had good deals and bad deals and overcome many challenges along the way. Talk to the timeline and the challenges you guys have had to overcome.
So before I do that, can I talk a little bit about where the name, what Rockstep means?
Yeah. Give us a little context.
Yeah. And so let me give a little context. So we've been in business 28 years. We've got 75 employees all over the country. Our headquarters is Houston. We have 15 here. And the word Rockstep, Matt, is not a word you find in the dictionary. But dancers know what it is. It is a dance move. And I like big band music. I don't know if you're familiar with big band, Matt, but Frank Sinatra and Ella Fitzgerald and Sammy Davis Jr. and Peggy Clooney and Rosemary Clooney, Peggy Lee. And that genre of big band, that genre of swing is one of my passions. And when you swing dance or ballroom dance, couple dance, you rock step on count 7 and 8. 1, 2, 3, 1, 2, 3, rock step. Ball pivot chain. So at your wedding or whatever, you were rock stepping when you were couple dancing. So we use it as a metaphor. We use it as a metaphor in the sense that we want to be nimble. We want to be light on our feet. We want to listen to the music in the industry. And if there is a problem, if there is an opportunity, we want to quickly switch directions. So we use it as a verb. Matt, we've got a problem here. We got a rock step. Everybody in our company knows what it means. Okay. We also have 25 rules of behavior, 25 of them. I wrote all 25, and then I wrote 3 or 4 sentences defining what it means. And these are the rules of behavior. These are our operating manual at our company. And everybody at this company has to live by these rules. We call these rules
Rockstep rules.
Rock steps. Close.
Rock
that was
steps,
good.
Okay.
50% answer. You got a 50%. We call them rock steps. And we have a rock step of the week. So the whole company, all 75 of us, get on a Teams call, 10 a.m., and we talk about rock step 15 this week. Invest in relationships. We do this twice a year. We rotate. So somebody wrote an essay. What does it mean to them personally and professionally to invest in relationships? And then they call on random 3 people of the 75, and we have a conversation about it. So we ritualize, what does it mean to invest in relationships? And this type of behavior, these rules, do the right thing always. Number 1, be punctual. Rock step number 3, keep family first. Rockstep 24. All of these, the language, I got to speak straight with you. Rockstep number 8. Okay. Be relentless about improvement. All of these is the language we use and the rituals we use about having conversations about how we treat each other, how we respect each other, how we deal with conflict. And as a result, we have a great high performance team. Okay. So when we interview for new people, you got to come to the interview. Hey, Matt, what are your favorite 3 and why? Rock steps. And what are your most challenging 3 and why? And you want me to give you mine real quick?
Yeah, please.
Okay. Favorite. Do the right thing always. Rock step number 1. We're an investment business. That's a world of gray. You've got to ask yourself, what's the right thing to do when you operate in a world of gray? Because that's the way the invest. So you got to stop. Hold on, guys. How do we deal with this? Second favorite. Rock step number 3, be punctual. And for me, on time is 5 minutes early. And then if you show up on time, you're late. And so my son drives me nuts. Everybody get in the car for dinner, then I'll turn my video off. Okay. Drives me nuts. He just doesn't have that same sense. And then my third favorite is keep family first. If you don't take care of your health, and if you don't take care of your family, you can't take care of Rockstep. And I mean it. And we use that term. So there's a problem in the family. Susan, okay, take 3 weeks off. Take care of your kid. Get it done. We're going to cover for you. So we believe it. I'm going to give you my 3 most challenging. Listen generously. Rockstep number 7. I do think women probably listen a little bit better than men, but I'm impatient. I'm thinking about what I want to say when you're speaking, and I interrupt, which is a terrible habit. My wife will completely verify this.
I share that challenge. So
all of you,
I'm 1 for 1 with you on that one.
Yeah. Be a fanatic about response time. It's another challenge. I've got so much coming at me that I just cannot respond as quickly as I'd like.
Okay.
Then Rockstep 25, have fun. As my wife says, Matt, Andy, you take the fun out of fun. Okay. So I am serious. I just have that serious personality. I will tell you on the inside, I'm very happy, Matt. Okay. Very happy, very content, very calm. My wife is very happy and smiley and laughing. On the inside, she's a nervous wreck. Okay. So we balance ourselves out. So again, we're not perfect.
Yep.
But these are the rules in our company, and I go to the mat. I mean, I'm talking, this is serious, to the mat. We will not grow if we can't find people who live by these rock steps. Yeah. Okay. To come to our company, you got to have the right skills. You got to be a professional. To stay at our company, you got to live by those darn rock steps.
That's great. I love that. One of my early mentors taught me, how critical the core values have been for growing his. He's got probably a $500 million net worth, and he lives and dies by his core values in his organization, and so do his people. And he rewards, based on alignment with those, and he, reprimands or course corrects based on misalignment with those things. And when you really think about how, I can at least speak from my own life. Life got a lot easier when I was in alignment with my core values and in synergy with my core values and belief systems versus the friction and the turmoil and the stress, that comes along with being out of alignment with those things. It's just a great reminder that, that infrastructure and belief system can oftentimes be the difference between an okay or a decent company and one that is absolutely crushing it and everybody's having a lot of fun doing it together.
Yeah. So what other questions do you have? What direction do you want to go here?
Well, I was asking a little bit more about some of the challenges, right? I mean, I think people are always exciting in investing and entrepreneurship in business. It's from the outside looking in, easy to go, man, they've got it all figured out, multimillionaire, decamillionaire, or, 100, 200, whatever it is. But I
Yeah.
don't think people often understand the sleepless nights, the challenges of, budget overruns and timelines being off, and an employee, screwing you over, doing something that, completely makes you question your sanity and being in this industry or taking these types of risks. So I'm just always curious around the psyche and, some of the physical, tangible things that you've had to overcome, maybe early on in your journey or, recently in your journey, and how you navigate those times.
Yeah. And so I will tell one of the challenges is it's intriguing. I used to operate in the metros, in the Houston, for example. And, I remember one of our, I wanted to get a big tenant here, and a broker said, you got to pay uh, uh, a higher commission for me, or I'm not even going to show somebody the site. And it's very unethical to do that kind of
Right.
stuff. Another one, you have to take the real estate managers on sex trips to Mexico. This is how deals got done. Okay. And I decided that, you know what? I want to play in a different fishbowl. I want to play in secondary, tertiary markets. I'm not saying that that there's not unethical things that happen in hometown markets, but there is a different spirit on average. And I'm not saying that the big metros are unethical, okay? But the incidence of it and the cutthroat nature of it and what people do to get ahead that's iffy, there is just a different feel.
Yeah.
And so I made the decision to go. I started with a company called Tractor Supply. I was going to do a Walmart deal in a town near Houston, secondary market, and Tractor Supply wanted the same spot. And I started a relationship with them and built a whole bunch of tractor supplies in small towns, smaller communities. And I realized everybody wants you to win. Everybody's helping you.
Yeah.
Yeah, it's just a different spirit and a different feel. In Hometown America, which is the name of our fund, is just a special place. And so that was a big moment for me.
Mm.
The other thing is that you've got to think like a retailer. That's my background. You want them to be profitable. You want them to have low rents. And so that means you've got to buy properties cheap.
Yeah.
And you've got to be able to provide low rents, because I understand the economics of store metrics. I understand what kind of investment and what kind of return these stores needs, and you can't get out of balance. Okay. And now, some markets we went into in the early days were too small. They did not have essential drivers. And so we have gotten better at identifying those markets that have essential drivers. So we've learned our lessons. And, it's, and we've really learned how to play. The toughest space in, I think, commercial real estate is the enclosed mall space.
Okay.
I think it's very, very tough. And that's why there's very few buyers, because it scares people, which is great. I've been in the Wall Street a whole bunch, and I tell the reporter, please, then keep the news bad. It's bad. Because I want the prices to be cheap. I don't want a lot of competition. So in the enclosed mall space, what we've come up with is a 3-part strategy on dealing with a complex asset. In some cases, the mall works just fine in its current architecture. Just fine, just buying it. We bought a property in Manhattan, Kansas at a 17 cap, and we've increased NOI, 50% leverage. We're returning cash 20% per year, just from cash flow, not with the refis.
Wow.
Cash. Others, second strategy is reduce the amount of retail and do something else there. So in Janesville, Wisconsin, we're reducing the retail by 50%. The city is building a $50 million hockey arena. And we'll end up with multifamily and hospitality. So reduce the retail. You got great real estate, great parking field, and you reduce retail to the right amount, and you do other stuff that the community needs. So we're demalling 6 of our 14 properties.
Oh, wow.
Okay. So one is led by a very powerful retailer, sexy retailer, and we're demolishing most of the center and starting again. 3 others is TJ Maxx, Ross, Five Below driven. We're facing everybody out, and then we're going to get rid of the interior of the mall. Okay. So that is a second strategy. The third strategy is arbitrage. Mm-hmm. You buy something at a 15, 16, 17 cap. You've got some restaurants that are included on a ground lease. You sell those at a 6 cap. Reduce your basis.
Yep.
Pay back your investors.
Yep.
So, we have a property in the Midwest. We bought, it's a $94 million note. We paid $12 million for the property at a 25 cap. We have sold off various pieces of the property for $17 million already. And we own the mall, paying $2.5 million of NOI per year with zero basis.
Amazing.
Okay. Great real estate. And other tenants are looking at coming in. And if not, nothing's wrong with lots of cash.
Yeah. Yeah.
Another one we're about to go under contract with is we're going to demall it, bring in some medical, bring in a grocery store. We're going to get some incentives from the city. We're excellent at getting incentives. You have a gap associated with, to get your 20% return to your investors, you've got to fill that gap and close that gap. And that's with economic incentives you need. And so what we're looking for is we're looking for great opportunities in hometowns. And then we're looking for investors both from those hometowns where we have an asset, but also people who really understand the hometown America spirit and like the conservativeness of hometowns.
Yeah. Talk about the investors a little bit. Have you structuring the deals?
Yeah. So
what does your capital stack look like? What do your investors expect or look for? What do you guys offer?
So we have a fund, Hometown America, targeting an 18 plus IRR with an 8 to 9% pref, depending whether you're at 100,000 or a million or 5 million. You get a better pref, you get a better split if you hit 1 million or 5 million. Okay. So that fund will have 5 to 7 properties in it. So it's diversified. A third of them will be open air. 2/3 will be malls. We're about to go under contract on a grocery anchored center in Louisiana right now at a 8.3 cap that was destroyed in a hurricane, and it was rebuilt for $32 million, not including land or site work. We're buying it for $20.2 million. Okay. Brand new roof, brand new facade. Tenants have been there on average 26 years in a market where there's a lot of manufacturing growth. And so that's an example of a grocery anchored center. Normally you can't buy them because they're 5 or 6 cap.
Yep.
This one is just a great deal. So that'll be part of the fund. So you can invest in 2 ways. You come in through the fund, diversified, 100,000 minimum. If you want to, you can co-invest at the deal level. Okay. So keep in mind, when we buy a secondary, tertiary market hometown property, local investors aren't going to want to come into the fund. They want to invest in their town.
Yeah.
So we create a co-investment vehicle. You can invest in that asset. The minimum's higher. So usually the minimum's $250,000 if you want to invest in that asset. But you'll get the asset if you come in through the fund. So the fund invests in every asset. So that's the approach. And you can learn more about this just by going to our website, go to rockstep.com, and you can read through how we think, and you can book an appointment with me.
Cool.
Get on the phone and we'll walk through this. And I love to talk about retail, the good and the bad. We're in very volatile times right now. Very volatile. I mean, just this
I wanted to get your opinion, before we wrapped up today on kind of what your thoughts are currently, what the outlook is going forward, how that impacts the commercial real estate industry, maybe retail specifically from your perspective?
Yeah. So let me try to answer it. I will tell you that it is unclear what the impact is. It's unclear.
Yep.
There is no doubt that consumers are more skittish. Just,
Yep.
they're skittish. Inflation, geopolitical risks, stuff going on,
A lot of
tariffs, no
uncertainty.
tariffs, all that. They're skittish. And as a result, some of them might be pulling back on purchases, which affects retail.
Yep.
Okay. On the other hand, for the first time in many years, people have seen what a powerful negative hit to their 401k looks like. Okay. I mean, like, bad.
Yep.
And so a boring real estate cash flow yield might look better than losing 20% in a week type of risk. The stock market does not go up all the time, and we are entering a more risky economic environment. Okay. So you've got to be very careful. You've got to be conservative. We offer kind of core plus up at top opportunistic. And we look at hundreds and hundreds and hundreds of deals to buy one, to buy two. And we've gotten better about analyzing downside risk. And so, look, alternative investments are not for everybody. But when you look at very wealthy people and you look at, the Tiger 21s and you look at the allocations of that group, alternatives is not 10% of somebody's portfolio, it's 20 or 50%. Okay. And so I could see some people moving into low risk alternatives. Other investors might just freeze for a while.
Yeah.
It's very, very unclear. We watch it very carefully. We study retailers. We study markets. We talk to our investors. What's happening in hometowns? Is it bad? Is it good? Is it stable? And we do that on a regular basis. We need to be piped in to the grittiness of these markets. And our local investors are very important for that. And our team. A lot of our team lives in hometowns. They've got our team, even if they have to have a heart for hometowns. It is a different world. Did I answer your question?
You did. And to wrap up, I'd love to know, based on, all the great success you've had, and obviously great wealth that you've built, what is the future vision for Rockstep, and why are you still doing this? What is your definition of wealth mean to you?
Well, Matt, I love what I do. It's fun. Okay. And look, business is all about problems. By definition, that's problems and opportunities.
Yep.
And I love it. I love building a team. I love doing something good for communities and making a good return for our investors. It is a true win-win. It's a hard space. I think all business is hard. You got to be gritty. You got to be both at the granular level and you've got to be at the strategic level. Always looking, listening, thinking, reading to see where the risks are and where the opportunities are. And you've got to rock step when problems and opportunities come.
Love that. Well, if you guys want to connect with Andy and learn a little bit more about Rockstep, what investment opportunities they have, and what they're up to, be sure to check out his episode, millionaiремindcast.com. We'll have all the links in there. Andy, thank you for joining us on the show today, brother.
Hey, Matt, it was a lot of fun. Thank you.
Well, that wraps up today's episode. Thank you so much for tuning in. As always, you guys know this show would not be what it is without you, the amazing listener, the support, sharing this out with other people who can gain value from it, taking 60 seconds to leave a review. If you haven't done so already, those things mean the world to us and ultimately help us spread this message out to as many people as we possibly can to help them on their wealth building journey. If you have any particular links or resources that you're trying to track down that were mentioned in this interview, be sure to check out this episode at millionairemindcast.com, where you can find access to all that information. And of course, if you haven't checked out the Wise Investor Vault yet, be sure to head over to wiseinvestorvault.com to check out all the tools, all the resources, the checklists, the spreadsheets, the trackers, all kinds of amazing things that can help you on your wealth building journey at the wiseinvestorvault.com. If you haven't connected with me on social media yet, I'm consistently putting out more content, stories, value to help you on your wealth building journey. And one of the best and most exciting things for me on a weekly basis is getting to connect with you guys. Getting your DMs, hearing what things impacted you, what you need help with is a big way that we continue to drive the content for this show. So if we're not connected and following each other on Instagram, on social media at official Matty A, give me a like and a follow. Would love to connect with you there. And of course, don't forget to get on my deals list. If you're an accredited investor, you want to look at more deal flow. You want to see what deals I have access to, what deals I'm raising capital for. This is an exclusive list that I only put out to my accredited investor list, my Millionaire Mindcast family. So text the word deals to 844-447-1555. And with that being said, thank you again so much for supporting the show. Until next week's episode, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers.